Over the next couple of sessions, we're going to be getting into some stuff that's going to be really useful for traders of the stock indices, i.e. the S&P, NASDAQ, Dow, or Russell futures. Also, if you happen to trade stocks, this will be very helpful in terms of analyzing the general market as a whole to give you a great bias for any stock that you might trade or to know which side to focus on that day, whether to be looking on the long side or the short side for stocks to trade. The stuff we're going to be discussing does not apply to other types of futures contracts like commodities. It won't apply, for instance, to oil or gold or any of those. It won't apply to currencies. This is just for the stock indices, and it'll be very helpful, again, if you're trading stocks themselves. Now, why is it specific to the stock indices and the stock market? Well, when you're looking at a commodity, let's say like gold or oil or corn, wheat, or whatever it is that you're looking at, you're usually trading a futures contract on a physical commodity. So you're trading the price of gold or oil or whatever it may be. But when you're trading the stock indices, let's say the S&P 500, for example, there's no physical commodity out there called the S&P 500. This is just an index, as is the NASDAQ or the Dow or the Russell. They're indexes. And as indices, they really represent a basket of stocks. What is the S&P 500? A lot of traders will trade these contracts without stopping to think what they're trading, because that influences behavior of a certain market. And the S&P 500, for instance, is basically the 500 largest stocks in the US, right? And the index is just a weighted price or an average price of these 500 stocks based on their capitalization, right? So right now, Apple is the biggest stock in the world by far. It would be the stock that influences the price of S&P 500 the most because it would take the biggest weight in that index. And then you'd have Microsoft and the other big companies that also comprise the S&P 500 taking a big weight in that index all the way through all the 500 stocks, right? So given the fact that the instrument you're trading when you're trading the stock indices is not some physical commodity in and of itself, but rather is just a composite, a weighted average of many different stocks, this means that we can look under the hood, so to say, of the specific stock index by seeing what the actual stocks that comprise it are doing, by gauging their behavior as separate stocks within that index. So let's get right into it. We have two major types of market internals that we look at to help us decipher the behavior of the stock indices. The first type is the advanced decline line. Now, what does this mean? Like we had said before, if you're looking at the S&P 500 index, it's really made up of 500 different stocks, all weighted as an average into a price that becomes the index. But when you're looking at the S&P 500 index moving up and down, what's going on beneath the surface to cause those movements? What are the individual stocks, the 500 stocks that make up the index, doing? The advanced decline line measures one aspect of that. What it basically tells you is this: how many stocks are advancing compared to yesterday's close, i.e. how many stocks are up today compared to yesterday's close, minus how many are declining compared to yesterday's close, right? So let's say there's 500 stocks, and let's say 250 are up today versus yesterday, and the other 250 are down. They're below their close of yesterday. What would the advanced decline line be showing? Well, it would be showing 0. 250 minus 250 is 0. So it would be basically telling you that the market is exactly neutral in terms of those 500 stocks. Half are up, half are down. Now, if 450 of them were up and 50 of them are down, the advanced decline line would show 400, right? So this is called the breadth indicator, the breadth of the market. And let's get into it on the chart and see what it's all about. Okay, let's get into the fun stuff. Now, if you don't know anything about market internals, you haven't seen them before, This may look like a crazy chart to you. It looks all chaotic, but once we've explained it all, it'll make much more sense and you'll be able to use this stuff to really help you in your trading of the stock indices or specific stocks. So let's expand the top panel of this chart. Okay, what we see here is the advanced decline line that we were talking about before for many different market days. Alright, so this one is a day, 1 day of market action, and we're not looking at prices of the S&P 500 futures, we're looking at the advanced decline line of the S&P 500. Here's another market day, here's another one, and so on. So now let's go deeper into 1 day and see what this is all about. Okay, here we are looking at one specific market day, and this is the advanced decline line of that day. Now if you'll notice, it looks just like prices. That's because we have it on a candlestick chart, and it looks, if you were looking at it without seeing the side here, without seeing the actual vertical scale of positive and negative, you wouldn't be able to distinguish it from a price chart. So now what's happening here? This line shows you that when the market opened, there was 100 more stocks advancing than there was declining. Alright, so there was 300 stocks that were up, 200 that were down. 300 minus 200 is 100 stocks advancing. And this started to rise. That means more stocks started to be up on the day than down on the day. Then it kind of went down, and then it really took off higher and hit a point where we have this green horizontal line where we hit 400, meaning that we had 450 stocks that were up on the day and only 50 that were down in the S&P 500. Now think about what that means. If 450 stocks of the S&P 500 are up, what do you think that is happening in the underlying index, in the actual S&P 500 index? Well, it obviously means that the index must be up. If most of the stocks are up and the index, right, is just an average of the prices of those stocks, and the vast majority of them are up, that means the index must be up quite a bit too. So let's actually look at what the index was doing on this day. Okay, here we are with this S&P price chart, the actual S&P 500 index price on the bottom pane, right? And then the top pane is the advanced decline that we were looking at. So they're overlaid on top of each other. Now, what do you notice if you look at this chart versus this chart? What's the first thing that you can tell? Well, it's pretty easy to see that they look very, very similar, almost identical. And this should only make sense. Like we said, this is just a collection of stocks weighted together to give you one price. And as the stocks advance and decline in their own right, it's going to affect this. So they're naturally going to look very similar. So if they look very similar, what is the point of having this? Doesn't it become redundant? Well, this is where the real value of breadth analysis comes in. This is where this market internal becomes very helpful. Because what we want to do is look under the hood. We want to look for divergences between the advanced decline line and the S&P 500 price. Now, what does that divergence mean between these two charts? So I've zeroed in a bit here to show you exactly what it means. So as these stocks were starting to advance more, and as more and more stocks were advancing than declining, obviously this reflects in the price of the index and we move higher, right? And here, as we hit the high, we hit over 400 in the advanced decline line. We hit a new high in price. So everything is in order right now. We're all moving in sync. But then look what happens here. An hour or so later in the day, we hit new price highs here. But what was happening to the advanced decline line? The advanced decline line was no longer hitting highs, right? In fact, it stayed below the 400 line, even though it had poked above it before. This is a divergence. And this is a tell that this new high is unlikely to be sustained. Alright? Now, of course, like anything else we've talked about, it's not as simple as just looking at this and go, oh, there's a divergence, so this thing's going to go down. Because this thing could have kept going higher and then this caught up to it, right? So it's not that simple. Like you've learned by now, it's all contextual. And you would have to look at the bigger picture and you would have to see, where is this up move coming in the context of? If we were overall, let's say, in one large downtrend, and now this up move is coming and hitting a major resistance area, and at this resistance area we got this divergence, that tells you something. That could be a great short, for instance. But if everything is bullish and this thing's just moving higher and this thing's diverging, it could be just a tiny little pullback in order, or it could just keep pummeling right through it. So you got to look at it in context. But for now, I just want to explain the basic theory behind it all. And this isn't one of those indicators. This isn't one of those secondary indicators that most traders look at. Like a moving average or a stochastics or MACD or any of that other stuff. All of those indicators are just derivatives of price. They take price and they do some mathematical calculations to it, and you get an indicator. And it just helps you see things visually, but they're not needed. This, however, is not just a price indicator. This goes beneath the price. This goes to the essence of what is making this price move in the stock index. And so it gives us new information, which is very important. Now here are some general rules about the advanced decline line. I've gone to another part of the chart to illustrate a point. We see on this day the advanced decline line opened somewhere around 475. You're talking pretty much almost every single stock in the S&P 500 is up on the day. That only happens when the market gaps up very large, which it did in this case. We're not seeing the gap here because I'm focusing just on this day, but there was a massive gap on this day. Alright? And what the advanced decline line did all day was it stayed pretty much flat the whole day long. Okay? But it sustained this whole area. During that time, the S&P 500 was rising, holding its gap, and rising, balancing most of the day, and then rising towards the end of the day. Now here you might say, okay, this thing was rising while this thing was flat, so isn't that a bad divergence? Well, when we get to extremes, this is one principle that you have to know about the advanced decline line. When we get to extremes, when we're over this 400 level, and especially over 450, this thing finds a very hard time trending anymore because very simply, it has an upper limit, and its upper limit is 500. At most, all 500 stocks can be up with no stocks down, and you hit 500. So this thing isn't like price that doesn't have upper limits. It has an upper limit. It's bound by plus 500 to minus 500. And given that when it hits extremes, there's so many stocks that can still be up on the day, so it can't really trend. So it holding here is a very bullish thing. And it holding in this extreme range is enough for price to continue to rise, as these stocks that are up on the day can become more up, right? Let's say assume, for a very simple example, that 475 of the 500 stocks are up, and each of them are up 1%. Now, even if no more stocks change from down to up, even if we stay at only 475 stocks up on the day, if these stocks that are up 1% now rise and they're all up 1.5%, well, guess what? The price is going to be rising. So when you're at these extremes, just holding the extremes is enough to allow price to continue moving in the direction of that extreme. And it's the same on the downside. When we get to minus 400 and below that, as long as we stay and we're holding in those levels, price can keep trending down all day long. And it can even be the case that this thing drifts down and yet prices still go up, mainly because even though it might be drifting down a bit, it's still at such an extreme level. And like I said, those stocks that are up are still increasing in price. And so price could still be increasing overall. So when you do have a gap up If you see that the advanced decline line is holding at a positive extreme, that's a good tell that you're going to have an uptrend day. That's one tell. Same if you are at a downside extreme, let's say below minus 400. That's a good tell if you keep holding there that you're going to likely keep trending down and that the market isn't going to reverse. Now we've gone to another chart, and here are a few more things. What you want to look at, unless you're at the extremes, unless you're above plus 400 or below minus 400, you just want to look at, you don't really care about the exact numbers of the advanced decline line. You just care about its trend. Where is it trending? If it's trending down, that means it's confirming a downtrending market. Same if it's trending up. Now, let's say the market gaps down. Well, the advanced decline line could open at minus 400 because most stocks are down compared to the previous day. But it could just trend up all day long. That would mean that the market gapped down and it is trending up all day long. So it's not the absolute number. If you see it at minus 400 at the beginning of the day, that doesn't mean anything in and of itself. That just means most stocks gap down and the market gap down, but doesn't mean we can't just trend up higher all day long, right? So it matters about the trend of it. Or if it keeps holding in a specific place that's extreme, that tells you something. But if it just opens there, that's not that big of a deal. Now, a very similar market internal, which we group with the same one as the S&P 500 advanced decline line, is the NYSE advanced decline line, i.e. the New York Stock Exchange advanced decline line. In this case, we're not looking at just the 500 stocks of the S&P 500. We're looking at all the stocks in the New York Stock Exchange. Now, obviously, because there are so many more stocks, right, this doesn't just go from minus 500 to plus 500. This can get somewhere near plus 3,000 and minus 3,000. But what's extreme historically for the NYSE advanced decline line is about plus 2,000 to minus 2,000. Those, if you're hitting plus 2,000, that's quite extreme, and if you're hitting minus 2,000, that's quite extreme too. When you're having a uptrend day, especially if you gap up and then keep moving higher, you're very likely at plus 2,000 and hovering around there. And same on the downside, you're very likely at minus 2,000 or lower and hovering around there. Its uses are pretty much exactly the same as the S&P 500 advanced decline line, except this one's just more broad. There's a lot bigger universe of stocks. It's not just specific to the S&P 500. It's telling us the market as a whole, the whole New York Stock Exchange, what is the breadth of it, right? And this is useful when, if you're, let's say you're trading the Russell, which is an index of 2,000 stocks. This is more broad. And you can even use this for the S&P 500. In my own trading, I barely ever use the S&P 500 advanced decline line. I just use this one, and it's pretty much the same. It gives you pretty much the same information, but I just wanted to highlight it here just to let you know that this might be the one you're more used to, the NYSE advanced decline line, and that's fine. It's all the same principles. This one, once it gets to about plus 2,000 or minus 2,000, that's it's extreme. Even if it's at plus 1,500, minus 1,500, that's quite extreme. If it's hovering around zero, you're having a balanced day. Nothing's going to be happening much in the markets. Don't be expecting a trend with this thing hovering around zero, or even only plus minus 500 or anywhere between minus 1,000 plus 1,000. That might be a trending move temporarily, but then it's not going to be a full-out trend day unless you get beyond those extremes. And one last thing I should mention as we look at different types of days. For instance, this day, just looking at it without even looking at the price chart, this must have been a day that gapped up quite high because we opened at 1,800, right? And since we sustained it most of the day, this day probably kept going higher. Here we drifted down to the end. That meant it probably gave back a bit or balanced, right? But just by looking at these, you can pretty much tell what was happening during the day. Now again, their uses, other than them holding extremes, reaching extremes and holding them, is the divergences. And think about why these matter. Why does breadth matter, right? Why do we look at these in general? Like you've noticed with our training, we don't do anything without understanding the reason behind why. We don't just look at indicators and just take them as they are. And the reason why is, think about this. Right now, Apple is such a large company that it makes up something like close to 5% of the whole S&P 500 index on its own. So think about a day when Apple gaps up huge, right? And continues higher and is up 4 or 5% on the day. Well, that alone is going to make the price of the index of the S&P 500 rise. But does that mean that the market is actually healthy? It's only one stock affecting the index because it's such a big weight of the index. Remember, the index is a weighted average. But what if 350 of the other stocks are all down? And yet those are the more smaller stocks, let's say, and 3 or 4 of the bigger stocks other than Apple are up for whatever reason, company specific news on them. Well, in that case, the S&P 500 could be up and rising, while in reality most stocks are falling. So there's a disconnect here. This means that breadth is bad, i.e. most stocks are going down. The only reason the index is up is because it's being influenced by its heaviest constituents. And so what does this mean for its health? If most stocks are falling, that's not a good thing. Its price is only being propped up by a few big stocks. So when we're looking at its chart, it's not showing us the real picture of what's actually happening in the stock market. And that's why the market internals, that's why looking at them is important. It shows us the real picture. And it shows us that this strength that we see in the S&P 500, it may not be for real because it's only a few stocks propping it up. And when these stocks tomorrow, let's say, are not up anymore, the price of the index is going to come into line with the rest of the stocks in the universe. And that's often where divergences come from, and often where we can get tells about when a move is likely to reverse. So those are all good things to know. And in the next session, we'll talk about market internal number 2, which is the NYSE tick. And then after that, we'll get into some contextual analysis via the market internals. Now, for those of you who are wondering what the symbol is to bring up these market internals, each platform is very different. All right? So whatever charting platform that you're using, either look in the help menu or email support or whatever and just try to find out, ask, what is the symbol for the S&P 500 advanced decline? What is the symbol for the New York Stock Exchange advanced decline? And then you'll be able to plot them alongside prices, either on the same panel like we did here, above and below each other, or on a completely different screen that you can keep an eye on them.